In this video, I'm going to talk about insurance and risk. Most of this is from Chapter 2 of the Rada McNamara text. Let's start with an outline of today's discussion. After you watch this video, you should be able to identify 4 characteristics of insurance, identify and describe 6 requirements of an insurable risk, define adverse selection, and explain the consequences of adverse selection, and explain how insurance companies try to control it. Adverse selection is an extremely important concept in the insurance business, so this is an important section. Next, you should be able to list 7 fields of insurance, as well as describe them, and explain the benefits of insurance, and explain the costs of insurance. So let's start with 4 important characteristics of insurance. They are risk transfer, payment for fortuitous losses, indemnification, and loss sharing. Let's start with risk transfer. Remember, insurance is risk transfer from the insured to the insurer. But it's only financial risk transfer. The risk is not actually transferred from the insured to the insurer. The losses still occur. It's the financial cost of risk. And often, not all of the financial cost is even transferred. Next, insurance is payment for fortuitous losses. So, what does it mean to be fortuitous losses? Well, fortuitous losses mean random. In other words, things that happen randomly or unpredictably. They should be accidental. This also is part of the definition of fortuitous. And they should be involuntary. The insured doesn't take them on purpose and didn't mean for them to happen. And they should be beyond the control of the insured, like a tornado. Next, let's talk about indemnification. Insurance should be financial restoration. It should make the insured financially whole. However, you'll see that in many cases, insurance does not make the insured financially whole. Later, in a different lecture, we'll talk about some of the ways that insurance violates indemnification. Also, insurance is loss sharing. In fact, often, insurance will be explained as risk transfer and loss sharing. So, it's the premiums of many people, the dollars of many people, going to pay for the loss of a small percentage of the group. Another phrase for it is risk pooling. One of my favorite ways to explain insurance is the payment of a small regular sum, the premium, from the many to pay a share of the loss of the unfortunate few. So the point of this is that insurance is a bunch of people getting together to help pay the losses of those who unpredictably have a loss. Sometimes people make the mistake of thinking that their payment of premium year after year and never having a loss makes them unlucky. But if you really think about it, it's the ones who actually have a loss that have the insurance coverage that are the unlucky ones, because not all aspects of the loss are covered. Even if you have a car accident that's paid 100% by your insurance company, there's a lot of hassle and pain that go along with that loss. Now let's discuss requirements of an insurable risk. They are: there should be a large number of homogeneous exposure units. Losses should be fortuitous and accidental, as I just discussed. Losses should be determinable and measurable. There should be no catastrophic loss potential. The chance of loss should be calculable, and the insurance transaction should be economically feasible. If you're a risk management and insurance major, you need to realize that these are really important concepts. You'll hear them a lot through all of your risk management and insurance classes. For one reason, surplus lines, which we study later in a course, violates many of these requirements. Examples would include entertainment risks like fireworks, oil and gas exposures, and hurricanes. We'll talk about some of these as we go through the requirements. So first, there should be a large number of homogeneous exposure units. The auto industry is a classic example of a large number of homogeneous exposure units. Most of the vehicles on this lot have a very similar exposure. They have a similar cost and they have a similar driving experience. But notice this vehicle, which of course I superimposed on this picture. This vehicle is clearly not the same exposure. For one, the property itself is more expensive than the other cars. But secondly, the exposure to loss is much greater. Frequency of loss is much higher than the other cars. So it wouldn't fit within the requirement of a large number of homogeneous loss exposures. It would likely have to be insured in the surplus lines. One of the primary reasons risks are often not fortuitous and accidental is that the insured takes them upon voluntarily, like investing in the stock market and gambling. These things are not fortuitous. They don't happen accidentally. When a person invests in the stock market or in any market or gambles, they know that they're taking a risk of loss, and they're doing it voluntarily, hoping to gain. Losses should be determinable and measurable. A broken heart is a good example of a loss that's not determinable and measurable. What is the financial cost of a broken heart if someone breaks up with you or ends a friendship or even a divorce? That's not determinable, so it's not insurable. However, the death of an individual is clearly a determinable loss. We know it's happened, but is someone's life actually measurable? In truth, a life is not directly measurable. Although some economists will make a good attempt at measuring loss, the value of a person, particularly one who is fairly young and hasn't worked for long, is not measurable. The way that we've dealt with this in the insurance industry is to assign a value to a policy before policy inception. These are called valued policies, and we'll discuss them more later. As long as the insurer is willing to sell that much life insurance, and as long as the owner of the policy can pay the premium, the insurance can be sold. So this is an insurable risk, despite the fact that the loss is really not measurable. There should be no catastrophic loss potential. Nuclear war, for example, would be catastrophic potentially, and therefore is non-insurable. Terrorism is potentially catastrophic, and in some cases this actually is insurable, but the insurance coverage that's provided is limited and it's often heavily reinsured through government terrorism insurance. Additionally, hurricane risks. The wind coverage on a homeowner's or commercial property policy covers hurricane exposures. However, risks that are close to the coast, that are heavily exposed to hurricane risks, often can't buy insurance through the standard insurance market and either has to go through the surplus lines or a state government insurer. Flood insurance is not insurable because of the catastrophic loss potential. Additionally, the chance of loss should be calculable. We generally don't know the frequency of loss from risks associated with space travel. So these are non-insurable, but can be insured in the surplus lines. And gene testing and other genetic work in the medical research industry. There are so many unknowns about the potential liability associated with gene testing that these are generally not insurable in the standard market. Lastly, the insurance transaction should be economically feasible. We talked in the risk management video about risks that are high frequency. When a risk is high frequency, for example, these tend not to be economically feasible because an insured would have to pay too much in order to transfer that risk, and there's really no benefit from transfer and pooling. Now let's talk about the important concept of adverse selection. Adverse selection can be defined as the tendency of people with higher risk exposures to buy more insurance. So who will buy more or more generous blank insurance? For example, who will buy more or more generous health insurance? A hypochondriac or a tough guy? Generally, you would assume that someone who knows they're going to use more insurance, who knows they're going to need more insurance, would buy more health insurance or a more generous health insurance policy. Who would buy more generous or more car insurance? This lady or this lady? Probably the woman who knows that she's a very aggressive driver would buy more car insurance, just so that she knows she's protected. And then who would buy more homeowners insurance? These guys or these guys? These are the Koch brothers, who are known to be extremely wealthy and conservative. One would think that the Koch brothers would buy more insurance, and they would be more likely to make a claim. Now, that might not be the case, because maybe the guys from Dumb and Dumber, if you've seen the movies, are going to have more homeowners losses because they make a lot of mistakes. But in general, you would find that people who buy more homeowners insurance and auto insurance and liability insurance engage in riskier behavior, and therefore will have more loss than the average person in the population. Adverse selection can make insurance rates too low. Remember when we calculated the expected loss for identity theft? The $350 that we came up with was based on the average population. But what if people who engage in more risky behavior, for example, they buy online more and they don't regularly check their credit score, buy more insurance to protect them from identity theft? The actual probability of loss might be 10%, higher than the frequency of loss we based on the average population. So actual losses will be $500 and not $350. The rate will be based on a number that is too low if we don't factor in adverse selection. So how do insurers cope with adverse selection? Do they charge higher rates to cover higher than average loss? Maybe. In some cases, yes, they might do that, knowing that they can't identify all types of adverse selection. But the most common way to block adverse selection is to try to determine the risk as much as possible. They ask a lot of questions about the insured and the exposure so that they know what the risk truly is. This is an example of an application for insurance. This is called underwriting. Underwriting is asking a lot of questions to assess the risk and to determine the appropriate premium to charge for an insurance policy, or to determine whether or not to write the policy at all. And the primary goal of insurance underwriting is to block adverse selection, because the more the insurance company knows about the risk, the more likely they can keep highly risky insureds from purchasing the insurance, or they can charge them more than they would someone who is just of average risk. Now let's talk about fields and categories of insurance. First, the fields of insurance. There are property insurance, liability insurance, also known as casualty insurance, which includes workers' compensation, health insurance, and it includes medical expense insurance, disability insurance, and long-term care insurance. There's excess and surplus lines, and reinsurance. And there's government insurance. I'll talk about government insurance in a moment. Now let's talk about categories of insurance. So insurance is categorized as either property and liability, or life and health, or sometimes life, accident, and health. And one of the reasons it's categorized this way is because insurance companies frequently specialize in one or the other. So you'll hear of property and liability insurers only, or life and health insurers only. Over the years, many insurance companies have gone multi-line, like State Farm, Allstate, and other big-name companies. Insurance can also be either commercial lines or personal lines. Many insurance companies sell both commercial and personal lines, but oftentimes agents and insurers specialize in one or the other. Either they're commercial brokers or agents, or commercial insurers. And then there's personal lines. Companies like State Farm and Allstate and Nationwide, Farmers, and Farm Bureau tend to specialize primarily in personal lines, but also engage in the commercial line side. Commercial insurance is insurance for businesses, and personal lines is insurance for individuals and families, such as homeowners insurance, auto insurance, and individual life and health insurance. Then there's group versus individual insurance. Group insurance is insurance that's sold through a group, usually an employer. Individual insurance is sold directly to the individual. Group insurance is usually less expensive, in part because the employer often pays a portion of the premium for the group insurance, but not always. The other reason it's less expensive is the insurance company is getting a large number of generally homogeneous exposures, and therefore they're willing to charge a lower premium. We'll talk about that more much later. Additionally, there's the admitted or standard market versus the non-admitted or non-standard market. The non-admitted market is the area of the insurance marketplace where surplus lines falls, as well as excess insurance and reinsurance. There's also public versus private insurance. Let's look a little more closely at public versus private insurance. Private insurance is insurance for individuals and private corporations. Public insurance is insurance that's specifically for government entities, schools, courthouses, other parish and federal government offices, for example. These have somewhat different exposures and different financial resources than private companies and private households. But note that public insurance is not government insurance. Public insurance, again, is for government entities. Government insurance is insurance for citizens and private companies that cannot be insured through the private insurance market, at least not through the standard market, such as the National Flood Insurance Program, crop insurance, Social Security, etc. Now let's look at the social benefits and social costs of insurance. Let's start with the social benefits. Insurance makes businesses and people whole so that they can continue doing what they were doing before. Without insurance, if you had a car accident and you didn't have the financial resources to get your car repaired, you might have to go without transportation, you might lose your job, or have to quit school. Insurance allows people to continue to be productive members of society. Also, people can worry less with insurance. They know that their family and their own financial security is protected, and the same is true for businesses. Additionally, entrepreneurship and innovation is much more possible knowing that if something goes wrong, you don't lose all of your life savings that you've invested in this new business, that you would have insurance coverage such as business income and liability insurance in the event that you're sued because of product malfunction or professional liability, for example. And insurance companies are great sources of investment. When you pay your premium to the insurance company, they turn around and invest billions of dollars back into the economy. Additionally, rating and underwriting encourage loss prevention. You get discounts for prevention efforts, like taking a driver safety program and having airbags in your vehicle. And you get rate increases for loss. So therefore, you're encouraged to actually prevent losses from ever happening in the first place. Loss prevention encouragement comes in lots of different forms with every type of insurance. There are lots of ways that insurance rates and underwriting encourage loss prevention. And these days, many insurance companies and insurance brokers have their own departments to help you determine how to reduce your loss experience. But there are social costs of insurance. The transactions cost alone can be significant. Of course, you have to pay actuaries and underwriters, and you have to pay the sales agent. Then there's moral hazard. Moral hazard includes things like arson. We talked about moral hazard before. Remember, it's the increase in the frequency and severity of loss because of the evil tendencies or amoral character of an insured. It's when an insured causes a loss or fakes a loss solely for the purposes of collecting on the insurance, and it is insurance fraud. You can see more about insurance fraud at insurancefraud.org. Then there's moral hazard, and we've talked about this before too. It's things like people driving through high water because they know they have car insurance in case they don't make it through, or people leaving their keys in their car, not really thinking as much about taking safety precautions because they know they have insurance. Both moral and moral hazard lead to more losses in society than there would otherwise be without insurance. However, loss prevention and loss reduction tools combat that significantly. And that's the end of our discussion of insurance and risk.